Welcome to TalkTickers. We're the deep dive that cuts through the chatter of earnings calls to bring you the essential insights quickly.
That's right.
Today, we're jumping into the Q2 2025 earnings call from a big name in consumer staples, a company really navigating a shifting market while pushing hard into those next-gen products.
Absolutely. And our mission for you, the listener, is pretty straightforward. Get you up to speed on what really matters from this call.
Yeah, the numbers, the strategies, the underlying trends shaping things. We'll cut through the noise for you.
Exactly. We want to distill it down to actionable knowledge. It's not just about the figures, it's the why behind them.
Yeah.
What they signal for the future.
Especially in this evolving space. So let's kick off with the overall picture. It sounds like they delivered a pretty solid quarter.
Very solid.
Yeah.
And management's tone was confident, which definitely seemed to play well with the market.
Okay, so what were the headline numbers that jumped out?
Well, the main thing is they beat expectations. Non-GAAP EPS hit $1.44. That's 6 cents better than consensus, up about 4.3% versus what analysts expected.
Okay, 6 cents beat. And revenue?
Revenue, if you exclude the excise taxes, came in at $5.29 billion. That was about $100 million over consensus.
So a beat on both top and bottom lines.
Yep, about a 1.9% beat on that revenue figure. Total net sales were $6.10 billion. And importantly, gross margin held strong at 63.1%.
63%, wow. And how did the market take all this? You said favorably.
Oh yeah, definitely favorable. The stock saw a big jump in trading volume, like over 2.3 times the average.
Significant interest then.
Right. And options activity looked pretty bullish too. It felt like what management was saying really lined up with how the market reacted. A cohesive story.
Good. That sets the stage nicely. Let's dig a bit deeper then into that financial performance and, how they're rewarding shareholders.
Sounds good.
So adjusted diluted EPS up 8.3% in the quarter to $1.44 by a fence and 7.2% for the first half. That's impressive growth. What's driving that?
Two main things, really. First, strong growth in their adjusted operating company's income OCI. And second, the impact of their share buybacks.
Okay, let's break down the OCI.
Right. So for smokeable products, the traditional cigarette business, OCI, actually grew 4.2% in Q2. And the margins there expanded to 64.5%.
64.5% margins on smokables.
Yeah. It shows they're still managing that core business very effectively, generating cash even as the market changes.
And you mentioned pricing power earlier. They achieved about 10% net price realization.
That's right. 10% for the quarter and actually 10.4% for the first half.
In this inflationary environment, what does that kind of pricing power tell you about their brands?
It says a lot about their brand strength, that loyalty. Even when consumers are feeling squeezed, they can still push through price increases like that. It signals a strong competitive advantage, a real moat.
Definitely speaks to the strength of the established portfolio. And they're returning that cash to shareholders too, right? Dividends?
Oh, absolutely. They paid out about $1.7 billion in dividends just in Q2. That brings the total to $3.5 billion for the first half.
Okay, big dividend payout. What about buybacks?
They were active there too. Repurchased 4.7 million shares in Q2, spending $274 million. That's part of about $600 million in buybacks so far this year.
And is there more authorized?
Yep. They still have $400 million left under the current plan, and they expect to finish that by the end of the year. It's a clear commitment.
And this is all underpinned by a healthy balance sheet.
Seems so. Their total debt to EBITDA ratio was 2.0 times at the end of June, right where they target it to be. Very disciplined.
Makes sense. And you can't ignore that dividend track record. 56 years.
56 consecutive years of increases. For income investors, that's a huge signal of stability, isn't it?
It really is. Okay, let's pivot now to one of the key growth areas, oral tobacco. The CEO specifically called out the nicotine pouch brand, On, as the substantial driver.
Yeah, On is clearly a success story right now.
So what do the numbers look like for On?
Pretty impressive. Shipment volume jumped 26.5% in the quarter. That's 52.1 million cans.
Wow, 26.5% volume growth and market share.
Also moving up, its retail share of the total oral tobacco category hit 8.7%. That's up 0.7 points compared to last year.
Okay, so strong volume and share gains. How are they achieving that? I saw something about their marketing.
Right, their It's On campaign seems quite effective. They did these in-person activations like music festivals, NASCAR races.
Reaching consumers directly.
Exactly. Engaged over 170,000 adult consumers that way in the first half. And digitally, their impressions more than doubled to 190 million.
And that's translating to awareness?
Apparently so. They reported a 7 percentage point increase in brand awareness. So these marketing efforts, both physical and digital, seem to be working well.
And how does this feed into the financials for the oral segment?
Crucially, the improving financial performance of on! Was the main engine behind the oral segment's profit growth this quarter. It wasn't just about grabbing share. It's actually driving profitability now.
So the investment in Next Gen is starting to pay off on the bottom line too.
That's the takeaway. It's becoming a significant earnings contributor.
Okay, so on alone is a blind spot. But let's talk about the other side of the coin, the traditional smokable products segment. Volumes are still under pressure there.
They are. Reported domestic cigarette volumes were down 10.2% in Q2. And for the first half, it was 11.9%.
And how does that compare to the industry overall?
The industry decline was estimated at about 8.5% for the quarter. So they're declining a bit faster than the overall industry.
Right. And we're seeing consumers trade down, aren't we? The discount segment is growing.
Yes, that's a clear trend. The discount segment's share grew 1.9 points year over year, and even 0.4 points just from the previous quarter. Consumers are definitely feeling those macroeconomic pressures.
So how is the company responding to that downtrading?
Well, tactically, they expanded their basic brand. They used data analytics to target about 30,000 specific stores for this expansion.
Interesting. So the idea is to keep those smokers within their brand family, even if they trade down, rather than losing them to a competitor's discount brand.
Exactly. It's a defensive move, trying to manage the portfolio across price tiers.
But does pushing a discount brand like Basic pose any risk to their premium crown jewel, Marlboro?
That's always the balancing act, isn't it? But interestingly, Marlboro actually held up well. It maintained its leadership in premium and even expanded its share slightly by 0.2 points to 59.5%.
So Marlboro's still dominant in premium despite the discount push.
Yeah. It seems the strategy is focused on overall portfolio share in a tough environment. Accepting some downtrading is inevitable, but trying to capture it internally. It feels pragmatic.
Makes sense. Any word on cigars?
Actually, yeah. Middleton Cigars showed some strength. Shipment volume was up 3.7%. They seem to be outperforming in that large mass cigar category.
Okay. Let's shift to another critical area, e-vapor. And the regulatory side is complex here. There was news on NJOY and that Juul patent dispute.
Right. The Patent Trial and Appeal Board didn't rule in their favor on that one, which is, a setback.
So what's the plan B?
Well, they're exploring an appeal, but what's more interesting is they've already finished designing a modified NJOY ACE product. They believe this new design gets around all 4 of the disputed patents.
So they're already working on a solution. Proactive.
Very proactive. It shows they're not just waiting. And they also mentioned building out a broader vapor portfolio, not putting all their eggs in one basket.
But the whole e-vapor market is complicated by the illicit trade, right?
Yeah.
Especially disposables.
Hugely complicated. Management keeps hammering this point. They estimate illicit disposables make up over 60% of the entire e-vapor category. That's huge. We're talking maybe 14.4 million users of these illicit products.
So what are they pushing for? And is anything actually happening?
They're advocating hard for stronger enforcement, obviously. And they did mention seeing some, let's say, encouraging signs. Increased actions by the FDA, customs, state authorities.
Leading to actual disruption.
Reportedly, yes. Some supply shortages of popular illicit brands have been noted. If that continues, it could start to level the playing field for legitimate, authorized products.
But getting those products authorized is still a bottleneck, isn't it? The FDA process.
That's the other major frustration they voiced. They highlighted waiting over 5 years for FDA decisions on some smoke-free product applications. 5 years.
That's a long time to wait for regulatory clarity.
It is. They're urging the FDA to speed up these PMTA reviews to create, a responsible market with actual choices for adult consumers.
And the CEO had a comment about NJOY Beret returning a market.
Yeah, he emphasized that when it does come back, assuming it gets authorized, they'll launch it in a very disciplined way, given what he called the current market disarray. Makes sense. You don't want to rush into that chaotic illicit scene.
Got it. And any other broader macro factors they mentioned? Tariffs, tax?
They touched on tariffs impacting the supply chain direct materials, packaging from overseas. They said it wasn't material to overall costs yet, but they're watching the impact on consumer spending power.
Okay.
More significantly, maybe, was the federal excise tax, the FET drawback. They pointed out competitors are using this policy, basically shifting production to avoid tax on imported products. They said they'll need to seek partnerships so they aren't at a competitive disadvantage there.
Right. Need to stay competitive on costs. Okay, let's look ahead then. guidance and outlook. They narrowed the EPS guidance range for the full year.
They did. They raised the bottom end. So the new range is $5.35 to $5.45 for adjusted EPS.
Which represents what kind of growth?
That's 3% to 5% year-over-year growth from the 2024 base of $5.19.
So even with cigarette volumes falling, they're still guiding to mid-single-digit EPS growth. What gives them that confidence?
A lot of it seems tied to that Optimize and Accelerate cost-saving program. It's on track, expected to deliver $1 billion in cumulative savings by 2026.
And those savings fund the future.
Exactly. They're reinvesting it into the smoke-free side, while keeping CapEx pretty disciplined, around $175 to $225 million for the year. It's that classic playbook. Optimize the core to fund the new growth areas.
They did acknowledge the pressure on consumers, though, right? Inflation, wages.
Oh, yeah, they were clear about that. Inflation outpacing wage growth, especially hitting lower-income consumers. But interestingly, they also expressed confidence that consumers will eventually adapt to these higher, even if stable prices.
Suggests they think demand is pretty sticky.
It does. It implies they believe their pricing power will hold, allowing them to keep delivering those results despite the headwinds.
And quickly, the ABI stake. Any update?
Adjusted equity earnings from their Anheuser-Busch InBev stake were down about 10.3% in Q2, but that was mainly because they sold off part of it last year. They still view it as a financial investment, looking to maximize its long-term value.
Okay, so let's pull this all together for the investor context. Management's story seemed to land well with the market. Why do you think this strategy, milking the cash cow while building the new thing, resonates so well right now?
I think it's the pragmatism. It's a clear dual strategy, and they communicate it well. Analysts seem mostly supportive, raising price targets, talking about operational resilience.
Even with the illicit trade issues.
Right. The buy side obviously likes the pricing power, though they're keeping a close eye on those volume declines. But look at the performance.
How's it stacked up?
The stock's total return has significantly beaten the S&P 500, beaten the Consumer Staples ETF, XLP, over the last month, 3 months, year. It even hit a 52-week high after the call.
So strong relative performance in a tough sector.
Definitely. It shows the market values this kind of stability and execution right now.
So looking ahead, what are the key things investors should be watching for? The catalysts.
Several big ones.
Yeah.
First, the FDA's menthol decision that's expected sometime in Q4 this year.
Huge potential impact.
Massive. Then, the PMTA verdict for that redesigned NJOY ACE product. Also, watch for them finishing that remaining $400 million buyback authorization. And usually they announce a dividend hike in August, so keep an eye out for that too.
And if NJOY ACE gets approved and launched successfully,
that could be a real narrative shifter. It could move the perception from just a steady yield vehicle towards, an actual emerging nicotine platform growth story. Big potential pivot.
But there are risks, too. Management flagged some uncertainties.
They did. The timing and specifics of any menthol ban are still big unknowns. There's also the ongoing risk of Engle-related litigation, those are old tobacco lawsuits.
Anything else?
Yeah, they mentioned a buildup in working capital tied to on-pouch inventory. They flagged that as something to watch, a potential yellow flag if demand for pouches were to suddenly slow down. So, need to keep an eye on inventory levels.
Got it. Important risks to monitor. Okay, it is time for our This Is Not Financial Advice segment. We take everything we've heard, the market reaction, the strategy, the risks, and pitch an outrageous but plausible trade idea.
For the savvy investor out there.
Exactly. So, given the positive market buzz, the core business strength funding the transition, the Bicker success, here's a thought.
Let's hear it.
Consider a long position in the stock. But here's the twist. Hedge it. Buy some out-of-the-money put options that expire after that Q4 2025 timeframe when we might get the FDA menthol decision.
Okay, long stock, protected by puts. What's the rationale?
Well, the company's shown amazing pricing power and cash flow, right? That funds the smoke-free stuff.
Yeah.
Sun is clearly working. NJYAC, if approved, is a major catalyst. The market likes the yield and stability.
Okay, that's the base case. What makes it outrageous?
The outrageous part is you're implicitly betting on things going well with regulation relatively soon. A favorable menthol outcome and NJYAC getting the green light. That's a lot to hope for from the FDA.
Fair point. So what makes it plausible?
The plausible part is that they are actively working around the patents for ACE. Enforcement is seemingly picking up against illicit vapes, which helps clear the way. And the puts give you that downside protection if the menthol decision is bad or if some unexpected lawsuit hits.
So it turns a regulatory gamble into a more calculated play on their execution.
Exactly. It becomes less about just collecting the dividend and more a bet that regulatory clarity could actually unlock significant upside, transforming the growth story. High conviction, but with a safety net.
Interesting angle. Okay, let's wrap this up then. Key takeaways.
We've seen a company managing a tough market pretty effectively, right? Delivering strong financials, investing smartly in smoke-free, especially with On doing so well. And the market seems to believe they can keep executing.
Yeah, what really stands out is that dual strategy. Maximize the cash from the old brands while carefully building the new ones. Disciplined.
It really poses the big question, doesn't it? Can this disciplined execution, combined with maybe some favorable regulatory wins, actually turn this reliable yield vehicle into a more dynamic growth story over the next few years?
That's the multi-billion-dollar question.
Yeah.
And just to reiterate,
This is absolutely not financial advice. Please always do your own research, your own due diligence.
couldn't agree more.
Well, thank you for tuning in to TalkTickers. We hope this deep dive gave you some valuable insights into that Q2 call.
What were your key takeaways? We'd genuinely love to hear your thoughts.
Thanks for listening.